Hey everyone, welcome to another deep dive with us. Today we're looking at building generational wealth. And it's funny because even with all the ups and downs over the years, the recessions, crashes,
Yeah.
the S&P 500 has still averaged around 10% growth every year for like the past century.
Oh,
So that really shows you the power of long-term investing.
yeah.
We're not talking about just getting rich quick here. We're talking about really creating a legacy that lasts, for generations.
Yeah, and what I think is really cool about this idea of generational wealth is that it's not just, something that only the super rich can do. We've got a ton of great information from experts who've really kind of cracked the code, so to speak.
Yeah.
And it all really starts with, a simple mindset shift.
Okay, so let's talk about that for a second. This whole mindset thing, I've heard it all before, think positive and manifest abundance. But how does that actually play out in the real world when it comes to, actually building wealth?
Well, it's really about understanding that building wealth isn't about, luck or a random chance or circumstance. It's about taking control. And one expert pointed out that a whopping 79% of U.S. millionaires are actually self-made.
Wow.
So they didn't inherit that money. They actually built it themselves.
So it's more about kind of like ditching that scarcity mentality, like the I can't afford it,
Right.
and really kind of embracing this idea that financial success is achievable
Exactly.
if you're willing to put in the effort.
Yeah, it's all about shifting from that scarcity to abundance.
Yeah.
Instead of focusing on what you don't have, what you lack, you focus on the resources you do have.
Right.
And the opportunities.
Yeah, but let's be real for a second. I mean, sometimes it feels like the system is kind of rigged against us. You work hard, you pay your bills, and you're just stuck on this treadmill, going nowhere fast.
That's a really crucial point. Understanding the rules of the game. One expert broke it down and explained how money flows. Money tends to flow toward investors, not just to those who are earning a salary.
Oh, interesting.
So think about it. Every time you buy something, that money is flowing to a business owner, an investor.
So are you saying that it's not enough to just earn a paycheck? We need to become owners ourselves, investors.
Right.
But that sounds kind of intimidating.
Well, sure, but it's about taking those small steps. Remember that $2,000 challenge
Yeah.
that one expert mentioned? Just cutting out unnecessary expenses, like those daily lattes or those subscription services you don't even use.
Right.
That can free up a surprising amount of money to start investing.
Yeah, and I think a lot of people get really caught up in this idea that investing requires, tons of money up front. But even small contributions can make a difference over time, right?
Absolutely.
Especially with compound interest.
Yeah, and one of the experts highlighted this really simple but powerful system. Just imagine having 3 accounts.
Okay.
One for spending, one for saving, and one for investing.
Makes sense.
And you can even automate it so that a portion of each paycheck goes directly into each account.
I like that. Okay, so I'm starting to get the picture here. But can we go back to that 3-account system for a sec? Because it sounds great in theory. But how do you decide what the right percentage is for each account? How much should I be spending versus saving versus investing?
That's a great question. And, there's no one-size-fits-all answer. It really depends on your, individual situation, your goals, your risk tolerance.
Sure.
But one expert suggested a general guideline of around 75% for spending, 15% for investing,
Okay.
and 10% for saving.
So even if you're on a really tight budget, you can still prioritize investing with that 15%.
Exactly.
Okay, but where do you even begin? I mean, the world of investing can feel so overwhelming.
Absolutely. There are so many options out there, but one expert suggested kind of breaking it down into 2 main approaches, active investing and passive investing.
Okay, so active investing, that would be like picking individual stocks, maybe doing some day trading.
Right.
Sounds exciting, but also pretty risky.
It can be, yeah, especially if you don't have the time or the expertise to really dedicate to, research and analysis.
Right.
Active investing really requires, a lot of hands-on involvement and a higher risk tolerance.
Yeah.
Passive investing, on the other hand, is more about taking that long-term hands-off approach.
Okay, so that would be more like investing in index funds
Exactly.
that track a specific market or sector.
Right.
And those could be a good option for beginners, right? Because they're more diversified,
Exactly.
less volatile.
And often they have lower fees than those actively managed funds, which can really eat into your returns over time.
Oh, for sure.
So passive investing is really about steadily growing your wealth alongside the market without having to constantly monitor everything.
So it's like choosing between being the captain of your own ship, you know, navigating those choppy waters of individual stocks, or, hopping on a cruise ship and just letting the market tides kind of guide you.
That's a great analogy.
So it's really about finding the approach that aligns with your comfort level
Yeah.
and your financial goals.
Right.
But even with index funds, you're still exposed to those market shifts and economic trends. And one expert talked about how, you know, major technological advancements, things like AI or clean energy,
Yeah.
can have ripple effects across all sorts of industries.
Absolutely.
And that creates both risks and opportunities.
Huge one for
Yeah.
investors.
Yeah, for example, the rise of AI is driving demand for, data centers, specialized software, even new energy sources.
Wow.
So these are trends that, savvy investors are paying attention to.
So you're saying that even if you choose more of a passive approach,
Right.
you still need to stay informed of
That's
these larger market forces. It's about understanding that bigger picture and positioning yourself to benefit from those long-term trends.
okay, that makes sense. But before we get too deep into, market analysis and all of that, can we take a step back for a minute and talk about the mental and emotional side of investing? Because that could be a real roller coaster.
Oh, yeah, definitely.
It's one thing to understand the concepts, but then to actually watch your investments go up and down, especially during those market downturns. It could be nerve-wracking.
Yeah, you hit on a crucial point there. Investing is as much a mental game
Yeah.
as it is a financial one.
Right?
One expert emphasized the importance of being prepared, not just financially,
Uh-huh.
but mentally, for those market fluctuations. They're inevitable.
So it's not just about having like a diversified portfolio, it's about having the emotional resilience to ride out those market storms
Exactly.
without making, rash decisions.
Right, market crashes are a part of the cycle, and panicking during a downturn can lead to those costly mistakes. One expert suggested viewing those market dips as potential buying opportunities.
Interesting.
So it's a chance to scoop up those great assets at a discount.
Okay, that's easy to say when you're not watching your portfolio value plummet.
I know.
But I see your point. It's about having that long-term perspective
Exactly.
and not letting fear kind of dictate your actions.
Right. It's about focusing on what you can control, your investment strategy, your research, your emotional responses,
Right.
and not getting caught up in that short-term noise.
Wow, we've covered a lot of ground. It's amazing to me how much goes into building true generational wealth. It's clearly not just about luck or being born rich. It's about mindset. It's about strategy. It's about commitment to creating that secure financial future for yourself and for generations to come.
Right.
But hold on a second. We've only just scratched the surface here. When we come back, we'll delve even deeper into specific investment strategies, how to navigate those market shifts, and we'll even explore the often overlooked but really crucial aspect of protecting your assets. So stay tuned, folks, because this deep dive is about to get even more fascinating.
Welcome back, everyone. Before the break, we were talking about, how important that mental game is when it comes to investing, especially when things get a little rocky.
Right, we were talking about how market dips, while scary, can actually present some really unique opportunities if you have the right mindset and strategy in place.
Exactly. Think of it this way. When a store has a sale, you're probably more likely to buy something that you've had your eye on, right?
Yeah.
It's the same principle with investing. Those market downturns can allow you to buy quality assets at a lower price.
Okay, I get the logic, but it still feels counterintuitive to invest when like everyone else is running for the hills. You know what I mean?
Yeah, I get it. It can feel that way.
So what advice do you have for overcoming that fear?
Well, one expert emphasized the importance of having a well-defined investment plan
Okay.
and sticking to it, regardless of, those market swings.
So you're saying it's not about timing the market perfectly. It's more about having that long-term strategy and trusting the process.
Exactly. And another really key aspect is diversification. We touched on this a bit before,
Right.
but it's worth diving a little deeper.
Right. We talked about how index funds can provide some diversification
Yeah.
by investing in a basket of stocks. But what other ways can you diversify your portfolio?
Well, think of it like building a strong foundation for a house.
Okay.
You wouldn't want to use just one type of material, right?
Right.
You'd want a mix of concrete, wood, steel, maybe even some sustainable options.
Sure.
Diversification in investing is similar. It's about spreading your investments across different asset classes.
Okay. So in addition to stocks, you might consider bonds, real estate,
Right.
maybe even commodities like gold or silver.
Exactly, because different asset classes tend to perform differently. Under various economic conditions, for example, when the stock market is down, bonds might hold their value or even increase, and that provides a buffer against losses.
So it's like having a financial safety net, kind of cushion the blow of that market volatility.
Exactly.
That makes sense. But for someone just starting out, the idea of managing all these different asset classes can feel really daunting. Are there any simplified approaches to diversification?
Well, one expert recommended something called the core and explore approach.
Core and explore.
Yeah, so this means building a core portfolio of low-cost, diversified investments like those index funds and ETFs that track the overall market.
Okay.
So that forms the foundation of your portfolio.
Okay, so that's the core. What about the explore part?
Well, once you have that solid core, you can then allocate a smaller portion of your portfolio to explore specific investment themes or sectors that you find particularly interesting or promising.
Okay, so maybe something like clean energy or artificial intelligence or even emerging markets.
Right.
It's about diversifying within those areas that align with your interests and your beliefs about the future.
Exactly. It allows you to kind of personalize your portfolio and potentially tap into those higher growth opportunities while still maintaining that diversified base.
This whole diversification concept is making me think back to those market shifts that we talked about earlier, knowing that different asset classes react differently to those economic trends. Could you strategically adjust your portfolio to ride the wave of those shifts?
That's a great observation, and that's exactly what active investors try to do. They're constantly analyzing market trends, economic data, even geopolitical events to try to identify those investment opportunities.
So, for example, if you believe that clean energy is going to be, a huge growth area, you might increase your investments in companies that are developing solar panels or wind turbines.
Exactly.
Or if you think that rising inflation is going to persist, you might increase your exposure to commodities like gold, which tend to hold their value during those inflationary periods.
Right.
But active investing requires a lot of research and a much deeper understanding of how markets work. It's not something you just jump into without doing your homework.
Absolutely. Active investing carries higher risks. It requires a much more hands-on approach. It's not for everyone.
Right.
That's why it's so important to choose an investment style that really aligns with, you know, your knowledge, your experience, and your risk tolerance.
So if you're not comfortable with active investing, sticking with that diversified portfolio of index funds and ETFs might be a more suitable approach.
For many people, that's a great starting point. It offers a good balance of growth potential and risk management without requiring, that constant monitoring or deep market expertise.
Okay, so we've talked about the investment side, from those mindset shifts to those active and passive approaches, and even the importance of diversification. But there's another crucial aspect of building generational wealth. That often gets overlooked.
You're talking about protecting your assets, both legally and from, potential threats.
Exactly.
It's something a lot of people don't even want to think about, but it's so crucial, especially as your wealth grows.
Right, we talked about building wealth, but what about safeguarding it? Where do you even begin with something like that?
Well, one expert emphasized the importance of assembling a team of trusted advisors.
Okay.
This could include an attorney specializing in estate planning, a tax advisor to help you navigate, the complexities of the tax code, maybe even an insurance broker to make sure you have the right coverage to protect against those unforeseen events.
So it's like building a financial fortress around your hard-earned wealth,
Exactly.
making sure it's protected from all angles.
Right, and it doesn't have to be overly complicated. Even simple steps like creating a will can make a huge difference in ensuring that your wishes are carried out and your loved ones are taken care of.
Yeah, I think a lot of people, myself included, used to think that estate planning was only for, the super wealthy.
Right.
But it's really about having that peace of mind, knowing that your affairs are in order, no matter how much wealth you've accumulated.
Absolutely. It's about taking control of your legacy and ensuring that your hard-earned wealth benefits those you care about most.
So having the right team of advisors seems really key as you navigate and the complexities of building and protecting wealth. But beyond just the legal and financial aspects, are there other ways to safeguard your assets?
Well, one expert highlighted the importance of having a risk management plan in place.
Okay.
This could include things like insurance to protect against those unexpected events, cybersecurity measures to safeguard your digital assets, even having physical security measures for your home or business.
It's like having a multi-layered approach
Right.
to protecting your wealth
Exactly.
from all those potential threats.
Internal and external.
Right.
And it's not just about protecting your wealth for yourself. It's about ensuring that it can be passed on to future generations.
Okay, that brings us to a really interesting point. We've talked a lot about the how of building generational wealth, but what about the why? What's the bigger purpose behind all of this?
That's where things get really inspiring. One expert talked about legacy, not just being about the money you leave behind, but about the values you instill,
Uh,
the impact you make on the world, and the opportunities you create for those future generations.
it's about creating a ripple effect that extends far beyond your own lifetime. It's
Exactly.
about empowering those future generations to live fulfilling lives and to make a positive difference in the world.
Precisely, generational wealth isn't just about financial security, it's about freedom. It's about giving your children and grandchildren the freedom to pursue their passions, to make a difference, to live those lives filled with purpose and meaning.
This has been an incredible conversation. We've covered so much ground, from the fundamentals of saving and investing to the importance of diversification, navigating those market shifts, and even that critical aspect of protecting your assets and legacy. But hold on, folks, we're not done yet. When we come back, we'll wrap up our deep dive with some final thoughts and some actionable steps that you can take to start building your own legacy of abundance and opportunity. Don't go anywhere. Welcome back to the deep dive. Exploring all these facets of generational wealth, from, the mindset to the market trends, it's clear to me that this is like a journey, not a quick fix.
Yeah, that's a great way to put it. It's about building those sustainable habits and those strategies that can benefit you and those future generations.
So for our listeners out there who are, ready to take that first step, where do you recommend they begin?
Well, one expert emphasized the importance of a financial checkup.
A financial checkup.
Yeah, think of it like a physical. For your finances, you assess your current situation, your income, expenses, assets, debts, just to get a clear picture of where you stand.
So it's about taking inventory before charting the course.
Exactly.
Okay, what are some practical ways to approach this financial checkup?
Well, you can start by tracking your spending for a month. Just no judgment, just honest observation.
Okay.
Then you can create a simple budget, just outlining where your money's going.
Uh-huh.
And then finally define your financial goals, both short-term and long-term. This clarity is really essential for making those informed decisions.
So it's like laying the foundation before building the house. You mentioned setting financial goals, and one expert talked about making them smart, specific, measurable, achievable, relevant, and time-bound.
Exactly. So instead of vaguely saying, I want to be wealthy, try something like, I want to invest $5,000 in a diversified portfolio within the next year.
Right.
That's specific, measurable, and achievable.
It makes it feel less intimidating, and it gives you a clear roadmap to follow. Throughout this whole deep dive, one theme that keeps coming up is the importance of mindset. It's not just about the mechanics of money, but it's also our beliefs and our attitudes towards wealth.
Oh, absolutely. One expert shared a really powerful quote: your income rarely exceeds your level of personal development.
That's interesting.
So building wealth often requires, expanding our comfort zones, embracing those new ideas, and cultivating that belief in our ability to succeed.
So it's about investing in yourself, your knowledge, your mindset, alongside investing your money.
Exactly.
That's a powerful concept.
And remember, this is a journey, not a race. Building generational wealth takes time. It takes patience. And it takes a willingness to learn and adapt along the way.
It's not about those get-rich-quick schemes. It's about making those consistent, informed decisions that compound over time.
Exactly. And as you progress, don't be afraid to seek guidance from those trusted professionals like financial advisors, tax specialists, estate planning attorneys. They can really help you navigate the complexities and optimize your strategies.
It's like having a team of experts in your corner, supporting you every step of the way.
Exactly.
But even with the best advisors, ultimately it comes down to taking action. One expert put it really wise. He said, the greatest enemy of a good plan is the dream of a perfect plan.
I love that quote.
It's a reminder to avoid that analysis paralysis and just start taking those small steps today, even if they seem insignificant at first.
Yeah, just make progress, learn from those experiences, and continually refine your approach.
Well, as we wrap up this deep dive, let's remember that generational wealth isn't just about, financial abundance. It's about creating that legacy of opportunity, of values, of impact. That extends far beyond our own lifetimes.
Exactly.
It's about empowering those future generations to live fulfilling lives and make a positive difference in the world.
It's about more than money. It's about leaving a positive mark on the world.
Well, this has been an incredible exploration of building generational wealth, and we hope it's sparked some ideas and some inspiration for you. Now we want to hear from you. Share your biggest takeaway in the comments below. What resonated with you the most? What action step are you going to take today? Let's keep this conversation going and build a brighter future together. And don't forget to like this episode and subscribe to The Deep Dive for more deep dives into topics that matter. Until next time, keep learning, keep growing, and keep building that generational wealth.